Hey, welcome back to another episode of Forex Tech Magazine. It's your host, Lewis. Hope you guys are doing well. Today is January the 9th, 2019. Well on our way into the new year. Hope you guys are making money. If you haven't made any money yet, stay tuned. Hopefully we'll give you some tips and tidbits that will help you be prosperous in the new year. But before we get into that, let's get into the disclaimer. Disclaimer goes a little something like this. Any and all information that is given to you or shared with you by Forex Text Magazine should be considered to be for entertainment and educational purposes only. Nothing that we share with us should be considered to be uh, investment advice. So if you're in need of a financial advisor, then our suggestion to you, or if you need for financial advice rather, our suggestion to you would be to seek out the assistance of a licensed competent advisor. Good. Now that we got that out of the way, let's go ahead and get right on into this. Why you came here, and that is to look at some trades. I gotta check one thing though, also before I do that. Sorry, guys. Just doing some housekeeping here, making sure that we there we go. Cool. Okay, cool. So let's look at some first things first. Well, let's get out of here. We're going to come back. We're going to talk about the U.S. Canadian dollar and the Australian U.S. dollar. But first, we're going to do is get into our normal currency pairs, which are the Great Britain pound pairs. Since this is the London Open, and that's what we typically trade during the London Open, which would be the Great Britain pound pairs. Sorry guys, last time I was having some issues with streaming, and I just want to make sure we got those things corrected. Looks like we have. Okay, so this right here is the Great Britain pound New Zealand dollar. This is on the hourly chart. Looks like we got some downward momentum going. Right, but overall, still hasn't dropped through that 0.618 retractment, right? You see what price pushed up, and you see what price started to push back down, right? So it looks like price is just kind of moving sideways still at the moment. So once again, this is one of the ones that you don't have to trade it. You know, if you look at something like this right here, you see this. This might be the one that you want to let it just kind of sit on the sidelines and just wait. If you do decide to get into this particular trade, what I would recommend, if you do, I would recommend doing it after price has crossed over to the buy side. Remember we talked about this before, right? Anything to the left is going to be sell side, right? So selling opportunities, and anything to the right is going to be buying opportunities, right? Because we are monitoring this for upward move, then we're going to be looking for something that's going to be crossing over to the left, which is going to indicate that it's the opportunity for us to potentially buy into this market. And then because we're in the red, this light price should push up to the red here. But now here's the little caveat with this right here, especially with this currency pair. It looks like we're hitting some resistance area, which we are, right? It was up in here and here. So these are resistance slash support zones, right? So it may be hard for price to push through to hit to that target. So what you may want to do then, because of that, you may want to put your initial target up at the support slash resistance area, right? And then once price is able to break through that and you get confirmation with another bar that's still bullish, then you might want to place your next target at this area, and the same thing, once price breaks through and you get confirmation candlestick that's bullish, then you can look to place your target up here at this area. So it's one of those things where you got to kind of be smart, because whenever you got support resistance area, price can and does tend at times to U-turn, and so you want to make sure that that U-turn doesn't knock you out of the market or wipe out any profits that you may have earned up until that point. Okay, so be very, very careful with that. Hey, good morning from Germany. How are you doing, my friend? This is Ray4Y. Hey, well, good morning, my friend. Hope you're doing well. Hope you're having a fantastic day, and hope you have been able to be profitable so far in the new year. If you haven't, hang tight with us. Hopefully, we can share some information with you that may make you profitable coming into the new year. Good morning. So anyway, get back to what I was saying before. Yeah, so be careful when you kind of going in placing this trade right here. I would probably look at placing my take profits right around these support/resistance zones, right? And not just trying to wait to take the big one up here. Just kind of take them periodically here, here, and then finally here. Okay? This makes more sense. Let's see what the next one is. The next one is going to be Great Britain pound, Canadian dollar. All right, so here's the fibs for this one. So you remember we're moving up, upward momentum, but then price dropped back below our A. This is A, B, C, and then we was trying to reach out to our D extension, which is here. We almost hit it, but we didn't get it, right? Price came incredibly low, and as before, it pushed through our A, so that lets us know that this price is no longer relevant, or this Fibonacci sequence is no longer relevant. So now we have to look at the new sequence that's taking place, which is the downward momentum type sequence, and that's where we drew our fibs, right? This became our A, this swing high became our A, the swing low became our B, and then this push up here was our C, right? So it's in the red, so that means that we're going red to red. That means our take profit is here, right? Which we're fastly approaching. But one of the things that we cautioned about when we first looked at this particular trade was be mindful of the support resistance zone here, because price could push through, but then it could try to retest it and push back up, and it did come down and try to retest it, but it didn't. It still continued to push down, right? And then the second thing we said, be careful with this area here, because this is another potential U-turn in the market, and price will come here and then push back up. And as you see, that's exactly what's happening. Price came down here, it's pushing back up. We also said to put your take profit here instead of here, because I think it was only about 30 pip. It was like a 20 or 30 pip different. It wasn't that much. Excuse me. Wasn't anything so significant that we just had to have it here. Yeah. Exactly, it was about 30 pips. So it's about 30 pip different between the D point, the D extension, and this support line. And I said go ahead and put your take profit here at the support line, just in case price bounces off of this and pushes back up in the opposite direction. So if we would have done that, guess what? You would have been profitable in this trade. You could still, if you wanted to, try to target this. I wouldn't necessarily do it. It's only like 30 pips. It's probably not worth it. Because whenever you put in a order, I always put in a stop loss. Just because it's habit. It's a good habit. And right now, at the bare minimum, our stop loss would be back up here by our C retractment, and that's way more than 30 pips, so your risk to reward will be way off. Although you do have the potential to get that 30 pips, there's better trades out there in the books. Let's just be honest, okay? So let's see what we got next. Oh, I'm sorry. So you wrote something. Let's see. Shorted U.S. Canadian dollar since the beginning of the crash. Made good pips. Yes. Good for you, my friend. Good for you. We're going to get into the U.S. Canadian dollar here in a moment. And we're going to do a little bit of analysis on that one, and we're also going to do a little bit of analysis on the Aussie US dollar as well. That's what we're trading off of our live account. So we're going to get to those in just a moment. So hang tight. We'll see if our analysis matches up with yours. All right, good deal. What's the next one we're going to look at? The next one we're going to look at is the Great Britain pound, Japanese yen. Bam. So once again, here was another one. Price had a pretty significant pullback. All right. We were looking at the overall momentum of this particular currency pair. Overall momentum, of course, was going to the downside, but here was a support area, right before we had that big crash a couple of days ago. And so what we kind of did is just went in and put some trend lines in place and just kind of seeing how this thing was moving overall. Right, we saw that once price broke above that downward trend that we was on the buy side, so we went in and set fibs accordingly. Right, here goes our A, here goes our B, here goes our C. There goes our D extension. Price hit the D extension, so now we need a new A, B, potential C, right? And that means that this is going to put our price extension up here to the D. Now, the question about this particular pair here was because we're having a moment of confluence where our downward trend is matching up perfectly with our horizontal support, right? So that can make for a really hard barrier for this price to try to push above. And as you see right here, it kind of went up and it tested it a little bit and it pushed back down. It's coming back up again and tested again, this downward trend line, and it may push back down. So one of the things that I recommended was to put your take profit somewhere around here, right? And now that price is pushed out even farther, right, I would probably say put your take profit off of the downward trend. Right, if it's able to break through the downward trend, then you can look at the horizontal support, and then if it's able to break through there, and then you get a bullish confirmation candlestick, then you go ahead and put your take profit at the original D extension. Right. Other than that, this particular pair, you got to really play it safe. Got to play it smart with these pairs, just because one thing you don't want to do is go out here and get crushed in the market just trading a very static, a very static position where you just might. Where you don't really understand how to manage your trade. And unfortunately, that's what happens with a lot of novice traders. They don't really understand how to manage the trade. And so what they'll do is they'll come in here and they'll say, okay, ABCD pattern. All right, this is my D extension. I'm just going to put my, target for my D. And they'll come in. They'll start making money. Price will start bouncing off of some of these support and resistance and these trend lines. And next thing you know, the money that they made, it gets wiped out of the account. And now they're pushing back into the negative, and they can't understand why. Why the fibs didn't work? Well, because you got a lot of support and resistance that's coming into play. And the whole thing about Fibonacci is not so much that it's going to guarantee that it's going to be successful every single time. But what it does, it gives you a high probability of success, because what you're doing is you're not just kind of making a random bias guess about where price is going to move in the market. You're actually looking at a formula, and not only are you looking at this formula, but everyone else in the market is looking at it too as well. All right, so if everybody's looking at the same thing, and we all determine at the same time that, hey, you know what, price bounced off at the 2.36, and so we know that the D extension would be up here at the 1.618. That means that there's going to be more potential buyers coming in to play that same exact strategy over time, right? So therefore, giving more confidence that this strategy is going to work for you, right? Versus me just kind of coming in eyeballing and say, yeah, I don't know, I think it's going to be 3 times higher than what it is from here to here. I don't know. Everybody got their own different strategies. Some of them work, most of them don't. Ideally, you just got to find out what works for you. Okay. All right, so let's look at the next one. And for this one right here, once again, this right here is like another one of those. It's kind of like the Great Britain pound, the zillion dollar we just looked at. It's kind of moving sideways right now at the moment. So this right here is another one that probably wouldn't necessarily recommend get in at the moment. It's one of the ones that you kind of look at, see how it plays out. if you do look to get into it, just kind of remember you wait for that counter trend line break, right? Counter trend line breaks are so important because it really kind of helps you determine where a good entry point is into the market. Right, and as you can see, even though the overall price is moving up, this is where we have a nice little pullback. Market's taking a breather, right? So we're looking at that trend line is going down. Then we see that counter, that break counter to where this trend line is going, right? Price pushes up, so that lets us know that this is potentially a good point for us to enter into the market because we're getting some bullish momentum, some buyers that come into the market, getting a push up. And so we would potentially enter in here and then look for our take profits, here and here, potentially. The other thing you got to look at and you got to kind of determine is what your risk reward ratio is going to be as well, right? And see if it makes sense for you. From here to here, that's only 81. From here, it's 130. And then from here to here, that's 243. So, the other thing you want to determine is where is your stop loss going to be at, right? Because we were up above the B, theoretically, we could put the stop loss back at our C, which would be here. So it's 95 pips. So 95 pips, risk of 95 pips to get 81 pips. Nah, definitely not something we would want to do. But risking 95 pips to get, 134, maybe. Risking 95 pips to get 238, definitely, right? The more conservative stop loss would be place it back here below the A, because we know that once it goes below the A, the trend is done, or that Fibonacci sequence rather is done. And back below the A, that's a 479 pip risk, which we would not risk 479 pips to capture 200 and what's that? 47, 43. So that wouldn't be a good risk. So yeah, if anything, we'll look to put my stop loss back below this little swing area here, the C, and then we'll see how it plays out. But once again, I think there's better trades to be made, so it's not something that we definitely or necessarily have to make. So that's the other thing. Don't force a trade. If it's not there, if you're not feeling it, don't worry about it. Just keep going. Let's see here, Greg. So if you don't mind asking, how long have you been trading? Oh, so for me, my friend, I've been trading for a little over 2 decades now. I've been doing it for a long time, and I always tell folks I made pretty much every bad mistake a trader can make. When I first started out, I borrowed money from a bank to trade, and that was back in 2008, right when the market crashed. Because I just knew I had the next big thing in play, and I watched my account balance go way down, and I had to pay all that money back, so that was ridiculous. When I first started trading, there wasn't a lot of information out there about trading. Wasn't a lot of information on the internet, so a lot of stuff I had to kind of like just learn on my own from trial and error. My original background was in property management, did that for several years, and then after I did property management, I went and worked with a firm. It was actually Prudential. I was a financial advisor with them for several years. Then went with another firm, worked with them for a short period of time, then just decided to kind of go out on my own for a little bit. So I've been in and out of markets for a while, just doing various capacities, just working on a lot of different financial products. The one thing that I found for me that I like best, though, is Forex. Just because instead of having to deal with the stocks, which you got thousands of different companies to choose from, and try to figure out which one is going to, is good, bad, or ugly. With Forex, you can pretty much narrow it down to about 6 pairs, and then you can narrow it down even lower than that, 2 or 3 pairs if you want to, and trade and be able to make a decent amount of money just from trading that. So for me personally, it's enjoyable. I like it. The other thing about Forex I like is that the countries themselves pretty much tell you what they're trying to do. There's no secret that the U.S. would love to be able to raise their interest rates right now, but again, to a point that is really not going to be is really conducive to the overall economy. So I don't know. If you follow a little bit of the fundamentals, the information is out there along with the technicals, you should be able to do pretty well with Forex. It's not something where you got to go out there and be a rocket scientist or anything like that. It says a lot to learn from you. Oh, a lot to learn from me. Yeah, hopefully you can learn the things that don't work for me, right? Learn from my mistakes, my friend. Learn from my mistakes. But you know, the one thing, and I'll tell you this right here, and I had just sent off an email to someone else that had, I was talking to earlier, and it was asking about um, learning to trade and all that stuff, and were we taking on any more students or anything like that? And I was telling them that not taking on any students right now at the time, not anymore right now at the time. If we do, maybe sometime in June, July this year. If you learn your Fibonacci's, right, that whole ABCD pattern, it's a pretty powerful pattern, and I'm gonna tell you, I've looked at a lot of different things, been through a lot of different courses. I've trained with a lot of different folks, and I'm gonna tell you, it's one of the more reliable patterns that is out there. There's a lot of things out there that can confuse you. There's a lot of indicators out there. There's a lot of stuff that's out there that just you look at it, it looks crazy. But the ABCD pattern is so freaking easy, man. You're like I'll show you right here, right? This was the A, this was the B, this was the C, that was the D extension, price hit, right? Now your C becomes the A, right? Your D becomes the B, right? Because here's a swing low, right? And then what you do is you find your C, which is here, right? And now you're looking for your D extension, right? Which is going to be here because it swung back to the red, and you're just going from red to red. It's color coded, right? Red to red, blue to blue, green to green. It's pretty freaking easy, right? Now, the one thing that I did caution folks about when we trade this particular pair here was that, once again, the support line. So you always got to be cautious of support lines when you go into a trade, just because those, once again, are U-turn points in the market, or potential U-turn points in the market. And so if you coming up against one, I would always say put your take profit right there at that support or resistance line. And then if price is able to push below it, and then you get a confirming candlestick, the price is still going to continue down, then you can make your D extension or whatever your next point to take profit. But always try to take as much money as you can off the table when you can. That's the one way to ensure that you can stay in trades longer, okay? Or stay in the game longer, period. Let's see here. So right now at the moment, don't really recommend trading anything out of this particular pair. Once again, it's just kind of moving sideways here and still kind of hugging to this support line. I mean, if you do feel like you got to trade this pair, if you feel like, well, I just want to be in it, that's not right. Give it a little bit more time. Let it cook a little bit more longer. Alright, let it do a little bit more time. It's coming up on it's like a little triangle, a little wedge right here. Alright, wait for price to break below this upward trend. Alright, and once price breaks below and closes below, then that would be your sell entry for you to get in and start selling this thing. Alright, and remember, there's your extension. It doesn't look like there's a huge amount of profit in this particular pair at the moment. So once again, that's another reason why I kind of give caution to this. If anything, what about 82 pips? 82, 85 pips. Not that much, but hey, if you want to get in on it, you can get in on it. But I would take extreme caution and wouldn't start a position until we cross below. Okay? All right. So let's look at the next one. The next one is going to be the Great Britain Pound US Dollar. Bam. Let's see here. Okay, good deal, man. Hey, good deal, my friend. I understand you got to go. Hey, I will catch up with you next time, man. Thanks for tuning in, though. I really appreciate the support, man. Really appreciate the support. All right, take care. So the next one here is the Great Britain Pound US Dollar. Once again, we're looking at some momentum in the market. Looking for our take profit to be here. This is our D extension. And as you can see, A, B, C, and this is what I was telling you before. I said it's kind of a shallow C right there. I was waiting for price to pull back a little bit heavier. And price did pull back heavier here, right? So to me, it's more of a valid C here, right? And so now the question becomes, where and when is price beginning to push back up, or has it already begun to push back up? And you see we're on the buy side of things, right? And price is beginning to make its move back up, which is cool. So it's 117 pips. Potential profit. If you feel comfortable with this swing here, you put this as your you can put this swing right here as your stop loss. Right, so you're risking about 40 pips to get 117 pips. It's definitely a good risk to reward ratio. If you're not comfortable with that, then you can come down here to the A, which is 199 pips. Put that as your stop loss. 109 pips to get 116 pips. Not a good reward to risk ratio. So wouldn't take that trade if that's where I got to place it at. So if you don't feel comfortable here and you feel more comfortable placing your stop loss back here, then that's not going to be the trade for you, probably, or at least not the trade for me. But if you do feel comfortable placing your stop loss here, then yeah, pushing up to the 1.618 could be potentially profitable for you because you're only risking about 40 pips to get 116 pips, right? So this particular pair here should, right now, typically you're kind of getting sideways trading right now in a lot of the Great Britain Pound pairs, and I think we covered this a while ago. Part of it is just because we're waiting on this decision for the vote and all the stuff coming out for Brexit. And I think once we get closer to that, which should be the next week or two, the closer we get to that, the more information we'll have. And I think the more direction you're going to start finding the market. I think the market's going to start finding some real direction here shortly, at least for the short term, and pull out of this kind of funky little sideways momentum that's going. The reason why you have this kind of pullback here is just because there was some extra strength in the U.S. dollar lately, and don't know how long that momentum is going to last. It's coming off some lows, so it could last for a couple more days, or it could turn around tomorrow. So just kind of be cautious about trading any dollar pair right now. Because we're still going through a lot of stuff over here in the States, and not to mention the whole thing with the tariff deals with China. So things to be things to be looking out for. Okay. The next thing we're going to look at will be, so let's go ahead and get into our analysis of. We'll look at the U.S. dollar, Canadian dollar. Now, my friend just recently said that they shorted the Canadian dollar, which was definitely the U.S. Canadian dollar, which is definitely the right move to make. And you see right here is our fibs, right, in place. And you can see the short as it took place here, right? So A, B, C, D extension, hit it, A, B, C, D extension, hit it, A, B, C, D extension, hit it again, and now we're back into the next A, B, right? Waiting for the C, and if the C breaks back into the red, then our D extension is going to be here. So, for my friend that was trading shorting the U.S. Canadian dollar, good job. You're definitely on the right track with that. We're waiting for the C pull back, and we want to make sure that this C, when it pulls back, that it doesn't pull back past the A, because if it pulls back past the A, that lets us know that we got a potential U-turn in the market, and now we're going to start looking at trading in the opposite direction. But for right now, it's at the early stages of making a pullback, so we don't know exactly what it's going to do just yet, but we will stay tuned, right, over the next 48 to 72 hours to kind of see what this thing is going to do. Could be a potentially good trade for someone. Good job, my friend. Let's look at the Aussie US dollar. This is actually one that we're in right now. So we got upward trading momentum, right? A, B, C over here. Could be, I think it's kind of a shallow C. I thought it should pull back a lot harder than that, but I think part of the issue is with the this trade agreement that's hopefully is going to be coming out of China. As you all know, the Aussie dollar is a proxy for the Chinese currency because they do so much trading with China. So therefore, how the Chinese economy goes, so goes the Aussie dollar at times. It's also a commodity currency as well, so it's tied significantly to the price of commodities. So you get a spike in commodity prices, you usually get a spike in the price of the Aussie dollar. The one curious thing about this is that the U.S. dollar has been pretty firm today against all its other pairs, and seeing how was it all of the other pairs? But yeah, for the most part, yes, the other pairs. But seeing how there was not that much of a pullback, and in fact, we see excuse me, spike up with the Aussie dollar. So telling me there's a lot of the underlying strength here with this currency pair, and so we do have the capacity to be able to push this up potentially here in the next 48 to 72. Just got to see how it's going to play out. The little lines that I got on here, the green line, of course, is my take profit over here at the 0.618 extension. This purple line is just where I originally purchased in at, and this is at I'm doing this off of a futures contract, right? And we talked about this earlier. The reason why we're doing futures contract is future contracts are or in some ways simpler, in some ways more complex than spot. Kind of explain the difference here. So the cool thing about the future contract is it's traded on a regulated exchange, right? Where spot is kind of traded at your brokers, right? A lot of people always complain about that when they trade on a spot at their broker, that their stop losses are targeted, and so some people don't like to trade with stop losses, which I don't recommend. You should always trade with a stop loss in place, not just a mental one. The other thing is the deposit amount that's needed for certain types of accounts. So what I mean by that is if you're trading a micro lot, I think it's about $20 deposit, but then it's like 10 cents a pip or something, depending on what currency pair you're trading. If you trade a mini lot, I think it's like $200 or $400 or something like that. But depending on, it might be $1 a pip depending on what you're trading. And then if you're trading like a standard lot, it's like $2,000 deposit, and it's gonna be $10 a pip. With a futures contract, a futures account, you get the advantage of being able to do like the mini or a micro, or not even a micro, or the mini and a standard account, but it'll cost less. It's less leverage, right? It's less money to deposit into the account. Just for instance, I'm trading the Aussie dollar right now, and it only costing me $137 to hold on to the position. That's the minimum account deposit, and then I have to have at least $122 in the account at any given time while I have this position on. That is the maintenance margin and so that allows me to be able to still participate in trade as long as I got that. So I can go down below my initial deposit of 137, as long as it stays at 122, I'm still in the trade, and I'm getting $1 per pip. Now I cannot go in and put in $137 and get $1 per pip trading in the States, in the United States, on any account, any broker that I know of, right? The other thing is, once I start to do a standard account where it's $10 a pip, here all I need to do is get about $1,100 or $1,200 in the account, and we can do it. Versus if I'm doing with a spot broker, you're gonna need about almost $3,000 in the account to be able to do that same $10 pip transaction. So once again, the leverage is a little bit better. Also, too, we have actual volume, right? That you can actually see volume that's into the trade. So that it gives a little bit more weight into your plans for your trades. As you can see here, there was a spike in volume when this thing had this big push down and then push back up. Next day, it had some more volume, not as high as that first day. So, third day, volume starting to wane a little bit more. Fourth day, it was a down day. Of course, volume was up, but it was negative, and this brings us to where we're at right now, where volume is up, but we're still just really kind of getting into the trading day. Also, too, because the Aussie US dollar is, you're going to see more money, more activity in this particular pair during the US trading market. So right now it's kind of just moving sideways, but as you see right here, this is the account values. Started out $360 on this account. We traded early and in the wrong direction on this one account, on one trade. So unfortunately, we lost coming out the gate, but that's okay though, because we're in the process of making that back up and building this back out. So it happens. That's the one thing about trading. I always tell people, you're gonna lose some, you're gonna win some, but the ideal is to make sure that your losses are small and that your winnings are big, so that way you stay in the game. Okay. But anyway, that's what we're looking at for this Aussie US dollar. We're looking to have our take profit at what's that, 0.7243, and our stop loss is at 0.6930, which essentially is take profit is up here. This is our D, and right now we got our stop loss back at our A, right, giving ourselves some room to play with this currency pair. As you can see, price has crossed over to the buy side, so we feel satisfied with buying, even though we're kind of getting a sideways momentum. Look at motion here. One thing that we could do, if we felt like it, we could push up our stop loss to go up under our initial, our C right here, right? But right now, I don't really trust this particular C, because I think the price could pull back some more. We're going to see, how far it pulls back, if it pulls back. But I feel good with where we're at right now. I think we got enough space, and I think that we got enough momentum that price should push up, unless something really crazy comes out of the market over the next couple of days about this this tariff agreement, which I got my fingers crossed that it really doesn't, right? And also too, I think tomorrow the FOMC is going to have their minutes from their meeting, so that's going to give the market a little bit more insight as far as what they're thinking in terms of rate increases for next year. But the Feds came out a couple times since, and it's already talked about, pretty dovish about, raising rates going into 2019. So I think that everything's kind of baked into the pie already, but you never know. And so, it's always good to be, always good to err on the side of caution. But anyway, so I think we should be pretty good on this particular pair. That's it for me for tonight. I am about to get out of here. Thank you guys for tuning in. I appreciate all the support, all the love. If you got any questions, hit us up at questions at forextechmagazine.com, or you can even get us at forextechmagazine.com@gmail.com. That's it, yeah. All right. Anyway, guys, love to hear from you. Take care. I will see you in another 24. Bye.